Welcome back to the deep dive. Today, we're cracking open something pretty fundamental in the crypto space. It's a project that, it's already processed over $154 billion in trades. Quietly,
That's right.
if you're using major crypto wallets, chances are you're interacting with this thing probably every day, and you might not even know it. We are diving deep into ZRX protocol, ticker ZRX.
Yeah, it's fascinating because most people focus on the flashy apps, the things you directly click on. But ZeroX isn't really an app in that sense. It's more like foundational plumbing. It's the invisible engine, if you will, for decentralized trading. Their mission statement actually says it all. Create a tokenized world where all value can flow freely.
I like that invisible engine. It fits. And that number, $154 billion across, 10 million wallets? That's not small potatoes.
No, it's huge. Staggering, really.
Yeah.
But the key thing today, its core value, is its API. Basically, it's a software bridge. It lets the big players think MetaMask, Coinbase Wallet, even Robinhood Wallet easily add trading features right into their own apps.
Ah, okay. So they're the utility provider, the Intel Inside, like you said, for DeFi trading.
Exactly.
All right, let's unpack this then. If ZeroX is this essential utility, what was the problem it was originally trying to solve? What was the mess in crypto trading that needed this engine?
Well, back when ZeroX started, there were two really big headaches in decentralized trading. First one was just fragmentation. Like, imagine all the different tokens scattered across literally hundreds of digital places.
Yeah.
We're talking over 130 protocols now running on like 15 plus different blockchains, Ethereum, Polygon, Base, you name it.
Okay, so if I want to swap my token A for token B, the best price might be hidden away on some obscure exchange on a different chain I'm not even using, and I wouldn't know.
Precisely.
Yeah.
It's incredibly hard to find the best price manually. And if you're building an app trying to scan every single liquidity pool, every automated market maker or AMM, it's basically impossible to do efficiently.
Right. That's the fragmentation part. What was the second problem?
The second one was just how clunky and expensive the early decentralized exchanges, the DEXs, were.
Expensive meaning gas fees again?
Exactly. Gas fees.
Yeah.
Every little thing, creating an order, canceling it because the price moved, even just changing the amount cost you gas.
Yeah.
It made trading frequently or making small adjustments just way too expensive and slow. It was a frustrating experience.
Okay, so scattered liquidity, high costs. Got it.
Yeah.
How does ZeroX actually tackle both? Give me the simple analogy. How does this engine work for, regular folks?
Okay, the best way to think about ZeroX is like a superpowered price comparison tool, like Kayak or Expedia, but specifically for crypto tokens. When you want to make a swap, its system, they call it a smart order router, instantly scans everything, every AMM pool, every possible source of liquidity, even other aggregators. It's relentless.
Wow, okay.
And then it automatically figures out the absolute best path. Sometimes that means breaking your big trade into smaller chunks and sending those pieces to different places simultaneously to get you the best overall price.
So it's basically doing all the heavy lifting for the developers building wallets or apps. They just plug into ZeroX instead of building that complex routing themselves.
That's exactly it. It's infrastructure as a service for DeFi liquidity. You get instant access to the best prices without the hassle.
Makes sense for finding the best price, but how did they solve the other problem, the cost and speed? You said early DEXs were slow and expensive. How is ZeroX cheaper and faster? What's the tech trick there?
Right. That's the core innovation, really. It's why they were so groundbreaking. It's what they call a hybrid architecture. It cleverly combines off-chain order relay with on-chain settlement.
Hybrid. Okay, slow down a sec. What does off-chain actually mean in practice, like for my trade?
It means efficiency, mainly cost efficiency.
Yeah.
See, the really expensive part of using a blockchain is writing data to it permanently, right? Paying those gas fees. So ZeroX's idea was, let's keep all the order creation stuff, setting the price, managing the order book. Let's do all that off-chain, outside the main blockchain. This is super fast, and critically, it costs zero gas. Sources suggest this saves users and developers up to like 70% on overall transaction costs.
Yeah. Wait, okay. If it's off-chain, how is it secure? What stops someone from messing with my order or, cheating the system if it's not directly on the blockchain yet?
That's the clever bit. Even though the order details are handled off-chain, you still sign that order cryptographically with your private key. That signature is your non-repudiable proof of intent. It's locked in. Only the final step, the actual swap of assets, the settlement happens on-chain. The smart contract verifies your signature and then swaps the tokens atomically, trustlessly.
Okay.
So you get the speed and low cost of off-chain for managing orders, but the full security and finality of the blockchain for the actual value transfer. Best of both worlds, really.
Got it. That hybrid system sounds smart for efficiency. But you mentioned other aggregators like 1inch. If they're also scanning all the public pools, what gives ZeroX a real edge? Something competitors can't easily copy.
All right, good question. This is where ZeroX adds another layer. They have something called the RFQ System Request for. Quote, they don't just scan the public pools that everyone else sees. Their API can actually send out a private request for a price, quote, directly to a network of professional market makers, or PMMs.
Private quotes. Why would a big market maker give ZeroX a special price instead of just putting their liquidity in the public pools?
Because it lets them offer a level of execution quality, especially for larger trades, that public pools often struggle with. This ties into avoiding something nasty called MEV.
MEV. Maximal extractable value. Heard of it? Sounds complicated. Break that down simply.
Okay, think of it like this. When you send a transaction on a blockchain, it usually sits in a public waiting room, the mempool, before miners or validators pick it up. If you send a big trade order there, sophisticated bots can see it coming. They can quickly buy the token you want before your transaction goes through, like your large purchase push the price up, and then immediately sell that token back for a profit. They basically sandwich your trade.
Ugh, that sounds like front-running. They're stealing value just because they saw my order coming.
Pretty much, yeah. It's a huge problem, especially for large traders or institutions moving serious money. They can lose a significant chunk to MEV.
So the ZeroX RFQ system helps avoid that.
Exactly. By getting a private quote directly from a market maker via the RFQ system, the trade often bypasses that public waiting room. It executes directly between you and the PMM. This means you typically get zero slippage. The price you're quoted is the price you actually get, and you're protected from those predatory MEV bots.
Ah, I see.
This access to deep, private, MEV-protected liquidity from professionals is a really strong advantage, especially for attracting institutional partners or powering wallets like Coinbase that handle huge volumes. It's harder for competitors to replicate that private network.
That zero slippage and MEV protection must be a huge selling point for partners like Coinbase and Robinhood. Okay, so switching back to the average user, like someone using MetaMask, what are the benefits they're actually seeing, even if they don't know ZeroX is under the hood?
For the end user, it should just feel seamless. Benefit 1, you consistently get access to really good, often the best prices, because it's checking over 130 sources. Benefit 2, it's reliable. The API boasts something like 99.92% uptime, which means your trades are very likely to go through without failing. And benefit 3, it's just frictionless. You don't need to go to a separate DEX website. The trading capability is built right into your wallet, working efficiently and securely in the background.
Okay, the tech seems solid. The adoption is clearly massive. That $154 billion figure keeps sticking in my head. But this leads to the weird part we found in the research, right? The paradox of the ZRX token itself. All that volume doesn't seem to translate directly into huge value for the token?
Yeah, it's the great ZRX paradox, as you called it. The token itself, ZRX, mainly has two functions right now. First is governance. ZRX holders get to vote on proposals for upgrading the protocol. These are called ZIIPs. They steer the ship, basically. Second is staking. Market makers, those PMMs we talked about, can stake ZRX tokens. By doing so, they earn a small share of the protocol fees, which are actually paid out in ETH, not ZRX. This incentivizes them to provide that good liquidity.
But why are the fees, and therefore the staking rewards, so low? With $154 billion in volume, you'd think the protocol fees would be generating significant revenue for stakers.
That's the crux of the issue. Fairly early on, the market kind of rejected the idea of paying fees directly in ZRX. It added friction, another token swap potentially. So the fee mechanism they settled on is really minimal. It's designed more to just slightly incentivize market makers rather than capture a large slice of the value flowing through the protocol. The sources we looked at describe the revenue generated for token holders via this mechanism as, well, insignificant, despite the massive trade volume. Oh, and it's worth noting, ZRX has a fixed max supply of 1 billion tokens, so it's not inflationary.
So the token's value today is mostly tied to governance rights and maybe future potential rather than direct earnings from the protocol's success. That feels a bit disconnected, doesn't it?
It does create a fascinating tension. You have this incredibly successful product, the API, that's deeply embedded in the DeFi ecosystem. Huge product market fit. But the tokenomics, the economic design of ZRX itself, hasn't really kept pace with capturing the value derived from those big B2B partnerships. The challenge now for the ZRX DAO, the community governing it, is figuring out if and how they can adjust things, maybe tweaks the fee structure or staking rewards to make ZRX accrue more value without hurting the core user experience of cheap, fast trades that made them successful in the first place. It's a tricky balancing act.
Yeah, and that perceived weakness in revenue capture must make them look like a target for competitors, right? Who else is fighting for this aggregator
Oh
space?
yeah, it's super competitive. You've got direct rivals like 1inch Network. They're really well known for their complex routing algorithm Pathfinder. They excel at finding pathways across lots of different, sometimes obscure liquidity pools.
Okay, so 1inch is strong on routing. What about competitors focused more on that MEV problem you mentioned?
Right there, you look at protocols like CowW Swap. They take a completely different approach using batch auctions. They try to match trades directly against each other before sending them to the blockchain, which offers really strong MEV protection by design, often avoiding those public mempools entirely.
So ZRX is battling rivals who are laser focused on either routing optimization or MEV protection while trying to do both well.
Exactly. It's a tough neighborhood.
Now, given that ZRX Labs, the company initially behind the protocol, is US based and works with big regulated players like Coinbase, how does regulatory risk factor in? Are they vulnerable to crackdowns from agencies like the CFTC or SEC?
Very much so. They're definitely aware of it, and they've actually had a direct run-in already. It's shaped their strategy significantly. Back in 2023, ZRX Labs settled with the U.S. Commodity Futures Trading Commission, the CFTC. They paid a fine of $200,000.
Ooh, okay. What was the fine for? Was it related to their core aggregation service?
No, not the core spot trading API. The issue was related to leveraged or margin trading products that were allegedly offered by a third party through Matcha, which is ZeroX Labs' own front-end showcase application. So even though it wasn't their core infrastructure offering, the fine was a clear signal. Regulators are looking at the whole DeFi stack, including the user interfaces built on top.
A $200 K fine doesn't sound catastrophic, but still not great. How did they turn that into an advantage, as you suggested earlier?
They leaned into it. They basically made compliance a feature. Right after the settlement, ZeroX moved quickly to integrate powerful compliance tools directly into their API. Specifically, they embedded Chainalysis address screening. This allows any application using the ZeroX API, like, say, Coinbase Wallet, to automatically check if a transaction involves wallets flagged as high risk or sanctioned.
Ah, okay. So by building in the compliance checks, they make their API much more attractive, maybe even necessary, for regulated institutions that absolutely cannot risk processing illicit funds.
Precisely. They're essentially saying, look, if you want to operate safely and compliantly, especially targeting U.S. users or institutions, our infrastructure helps you do that out of the box. It builds a moat of trust and regulatory preparedness.
Making themselves the institutional grade choice. Clever pivot.
Exactly. It makes them incredibly sticky for those big regulated partners. So let's boil it down. What's the key takeaway here? ZeroX protocol is really a cornerstone piece of Web3 infrastructure. Mature, battle-tested, it acts as arguably the best, most reliable, and increasingly compliant liquidity aggregator powering trading inside major apps like MetaMask and Coinbase. Its success comes from that smart hybrid tech and its growing focus on institutional needs and compliance. All this, despite the current weakness in how its own ZRX token captures economic value from all that activity.
That sums it up really well. Great tech, huge adoption, but this lingering question mark over the token's direct economic link.
Which leads to the final thought, maybe something for you to ponder. The biggest challenge for ZRX probably isn't fending off the next shiny new DAX. It's more of an internal governance challenge. Can the ZRX DAO figure out how to evolve the ZRX tokenomics? Can they make it capture a fair share of that $154 billion in value flowing through its pipes, value generated by its crucial B2B role, without breaking the magic that got them here? That's the billion-dollar question, maybe literally.
You know, this is a great point to quickly pause and remind our listeners of something.
That's right. If you're enjoying how we break down these complex projects into simple pieces and want more reviews just like this, make sure you subscribe to our channel, CryptoBox. We do all the complex research, so you don't have to.
Definitely check it out. We'll catch you next time for another deep dive.